cook, breathe.
You may have seen the ads popping up on social media.
How to get instant cash when you need it for life's emergencies.
Offering a quick way to get an advance on your upcoming paycheck.
Yes.
Make everyday payday.
Aimed at people in need of an immediate loan to help cover anything from rent to bills to groceries.
Life doesn't happen bi-weekly. Neither should payday.
And accessible not through a brick and mortar payday lender, but through an app on your cell phone.
And remember, you can get your earned pay any day.
And these earned wage access apps, sometimes referred to as cash advance apps, advanced some $9.5 billion to consumers in 2020 alone, according to the U.S. Treasury Department. And it's an industry that is continuing to grow. They spot users the money they need up front, which is then repaid on payday. And while some employers, including Walmart and Amazon, offer this service to their workers, other companies offer wage access directly to consumers.
People are paying quite a lot to use these apps. I mean, it doesn't necessarily look like a lot at first glance.
Andrew Kushner is Senior Policy Counsel for the Center for Responsible Lending, a consumer protection advocacy group that supports California's current move to regulate this expanding industry, an industry that operates in a legal gray area with little federal oversight.
The California state regulator found that folks are paying over 300% APR to get access, to take these advances out, which is, extremely expensive.
Technically, these apps do not charge traditional interest like a payday loan, but instead can make money by charging workers in other ways, such as a monthly membership fee, a fee for instant access or same-day deposit, a fee per bank transfer, as well as an optional tip after each transaction, which some users say they feel pressured to pay.
We think of these products as payday loans, with a fintech veneer.
But not everyone views it that way.
It does help to alleviate financial stress.
Angelina Bradfield is head of policy and government relations for the Financial Technology Association, which represents this industry. She says these apps help users control their money in a more responsible way because they're tapping into their own earned wages.
This really allows for them in particular to be able to manage their finances in sort of a more sustained way.
She also says that the industry welcomes regulation, but takes issue with calling these products a loan.
It is argued that they're not a loan. The fact that there are no mandatory fees, no interest fees, no late fees. Customers have no legal obligation to repay.
But consumer advocates blast this idea that the funds provided through these apps are not loans.
What you have is basically an agreement to receive money from someone and to pay that money back later. That's a loan. And it's a payday loan that you get through your cell phone, rather than going to a storefront lender.
Kushner also says that these apps can trap users in a debt spiral.
Folks very easily find themselves in a cycle where they're forced to reborrow, forced to pay these fees, or pressured to tip to keep getting access to these products.
If ultimately approved, California's proposed regulations would require these companies to register with the state. They'd also categorize these income-based advances as loans under California financing law, capping the interest that could be charged, and would consider current fees and tips as charges. And while the industry does not agree with this definition,
we believe that these are not loans. They do not have the aspects of a loan.
Consumer advocates argued these proposed regulations are critical.
People in our most vulnerable situations who need cash to make ends meet aren't being gouged with unlawful fees.
And the state is expected to make a final decision on these proposed regulations by March of next year. For more information, just go to CBS8.com, click on the online version of this story.